Our main conviction in terms of investment strategy for 2018 remains to stay optimistic for risky assets. And so we believe that the stock markets will make new highs this year. We have three main reasons why we expect the bull market to continue. First of all, economic growth is moderate but solid and global. So the corporate sector will continue to deliver earnings growth. Secondly, compared to interest rates, there is clearly a favorable environment for equity markets. The valuations, this is the third argument, the valuations are still favorable for equity markets, except eventually the US market, which is relatively expensive. Overall, equity markets will continue to rise, even if we expect volatility to be higher in the near future, because we think that technically we are in an overbought situation and equity markets need to come back towards the 200-day moving average. So longer term, we stick to the positive view and positive recommendation concerning equity market, but for the short term, we are neutral, expecting a consolidation. We expect the Federal Reserve to normalize its monetary policy very smoothly. We expect 3 times 25 bips in 2018, but no move the following year. The Fed balance sheet will be reduced very gradually with no impact on the markets. The ECB will continue its quantitative easing, probably extending it toward the end of this year, but they will probably decide to reduce the total amount of monthly buying. Nevertheless, the impact on the bond market should be quite minimal. Yes, inflation is about to rise somewhat, but in total we expect bond yields to move up only by 50 bips. So it would be relatively moderate tightening of financial conditions. As an asset class, fixed income assets will deliver very poor return in 2018. As we expect monetary policies to be relatively stable this year, we think that volatility on currencies will remain low. And for instance, we expect the euro-dollar to stay around 120, the current level, which is also our 12-month target. As our main recommendation is to take more risk at the beginning of 2018, we also stress the fact that we advise to diversify the bet as much as possible. So, in other words, do not put all your eggs in one basket. This is the reason why, for instance, we like to have some gold in the portfolio. It's a hedge against the risk in general, specifically the geopolitical risk or higher volatility on equities. But also real estate in direct investment or through funds is a good way to diversify. Also, alternative investments with UCITS, for example, in global macro or event-driven strategies. Thank you for your attention.